So we are very lucky to have Joshua Cohen, who is the student loan lawyer. So he actually passed the bar in 2008, and he has worked for legal aid. He's also done some consumer protection work. So he's been around for a while for sure. He does all student loan work, and he filed this I found really interesting in your bio. Filed your first class action against the student loan industry. So maybe if we have time, we can talk about that a little bit.
Yep.
So today he has so kindly agreed to come and answer questions for us on student loans. And I know we have a lot. So he does not have a formal presentation today. So what we're going to do instead, we're going to do an open question and answer session. So if you guys can do me a favor, you can either raise your hands, you can put your questions in the chat if you like, and we could do it that way. Otherwise, I'm going to start off. I'm going to ask him some questions. We'll just kind of get it, and then you guys can start thinking about your questions. Maybe Josh, if you want to start off with just, like that you think would be interesting for CROs, just in general that you normally talk about. Like I know when
Sure.
you at CreditCon, you had a great presentation.
Yeah. So, credit card, we saw the precursor to the One Big Beautiful Bill and what was going on. And it is now law. And I just want to touch on that with some deadlines so that you folks know a little bit more than what your clients know. That's what makes you an expert. If you know more than them, then you're an expert. Doesn't matter how much more you know. So, income-based repayment is still valid. It is still acceptable, and it is here for the long run, both regular income-based repayment and new income-based repayment, which started in 2014. SAVE is dead. That lawsuit is still going on. And the only reason the lawsuit is going on is because the people that are in the SAVE forbearance will be mass migrated when they wrap up that lawsuit. And what they're waiting on is to enact or to create enrollment in the new plan called RAP.
What is
Uh,
that called?
RAP, RAP, Repayment Assistance Program, which honestly is another income-driven repayment plan. They're just not calling it that, but it is an income plan. Okay. So that has to be rolled out by July. They're going to roll it out sooner. And that, from what I understand and from a lot of advocates I work with, we think Ed's plan is once they roll it out, we're thinking February or March, then they will end the SAVE litigation and migrate everybody into RAP. That might be good. That might be bad. One question we have about RAP, when I presented at CreditCon at that time, RAP was written up as a one-way door. Once you're in it, you can't get out. The legislation that passed, the budget bill, doesn't make that clear. And we're not sure if RAP is a one-way door, but we're hoping to find out before it is released, again, during February or March. So the SAVE lawsuit is going to dovetail into RAP. But SAVE is dead, and the precursor to SAVE was Repay. That's also dead. It's not coming back. Okay.
Okay.
So with two plans, pay and income contingent. What's happening with those? A few things. Number one, because of the SAVE lawsuit, there's an injunction in place. Nobody is allowed to be granted forbearance. Sorry, try that again. Nobody is allowed to be granted forgiveness under pay or income contingent. If you happen to have a client that has enough time to get forgiveness under ICR or pay, they can't have it right now. And my bet is the court will say they can't ever have it. That's fine. Don't panic. We'll get to that in a minute. Pay and ICR, even if they survive the lawsuit, they will officially sunset July 1st, 2028. So anybody in those programs will be funneled into income-based repayment. That's good for IC because IBR is cheaper. That's bad for pay because IBR is one, more expensive, and two, requires 5 more years of payment for forgiveness. Pay was 20 years, IBR is 25. But people will still get forgiveness. So it's better than it could be. Uh, Not as bad as it could be. Let me say it that way. Um, so pay an ICR, still use it, they'll still get forgiveness credit. And if they reach the mark, if they reach 25 years, I'm telling people enroll in IBR. Now you can be awarded forgiveness. IBR can have forgiveness. That was not touched by the bill, not touched by the SAVE litigation. IBR is safe. Okay. RAP also comes with, but it's a 30-year plan. My God. So RAP is not
Wow.
bad. You have to run numbers. RAP might be cheaper than IBR, and it might be better than IBR in the long run. It might not. You have to run numbers, which is really what I do for a lot of clients. It's run numbers.
Okay.
So that's the first thing. Oh, the biggest problem, the budget bill, is what happens after July 1st, 2026. Any loan before that date, before this summer, is what we call legacy loans. Any loan originated July 1st, 2026 or later is what I'm calling an OBBB loan, budget bill loan. They can't have any income-driven repayment plan. They can't have IBR, ICR, pay, none of those. They can only have RAP or a standard plan. That's it. Why is this important? Anybody that has loans now and does a consolidation that funds after July 1st, 2026, converts their legacy loans into OBBB loans. They lose IDR. So if you have a client that needs a consolidation in order to qualify for IBR, they got to make sure it funds before June 30th, 2020, June 30th, 2026. It gets worse. Plus borrowers. You've known in the past they can only have ICR. The good news, they can now have IBR, that's cheaper. The bad news is only legacy Parent Plus borrowers can have IBR. Any Parent Plus loan that is borrowed after July 1st, 2026, they don't get any IDR. They don't even get RAP. It is only a standard plan. So Parent Plus borrowers after July 1st, 2026, if they take out a new loan in 2026, all of their Parent Plus loans, even legacy, lose IDR. They can only have a standard pay it off plan. I can almost guarantee these people are going to have to file a bankruptcy to survive. So Parent Plus is very tenuous for legacy borrowers. It's not actually as bad for new borrowers because Parent Plus has caps starting in 2026. I'm willing to bet that you've seen Parent Plus borrowers that have 6-digit balances. Piece of cake. That's not going to happen anymore. Starting July of 2026, they can only borrow $20,000 a year and $65,000 lifetime per child. So each child can only have $65,000 worth of Parent Plus loans over their lifetime. So we're not going to see as much runaway Parent Plus loan borrowing. That's good, especially since they have to be in a standard pay it off plan. So
Okay.
all right, I just wanted to get that out because that's really
Yeah, that's
so.
all super confusing.
Yes,
So, so let me ask a question of just on right now with, so it's something we kind of
yep,
touched on for a second prior to the call starting. Right now, because everything was in over the COVID deferment for quite some time, right? So everybody got used to not paying their student loans, right, for the
yep.
last, 4 years or so, 5 years. And so now that they did become due, like now we're seeing a whole bunch of people with a lot of brand new late on their student loans, hitting that 90-day lates hitting just
Yep.
like, and then they're calling us and freaking out. Oh my gosh, they didn't even contact me, which we all know is a bunch of crap. They did do over and over because my husband has one and he got emailed nonstop about his loan coming due again. So
So
can we talk about
there's
that?
actually something there. There was actually a systemic issue where we're not sure that servicers actually did send out those first 90 days. And
Okay.
I've got enough in the neighborhood, not just me, but from other advocates, that I believe is a larger advocacy group that is looking at a class action against the servicers for failing to properly start the billing process. It's a little muddled because under the terms of the prom note, you owe it whether you get a statement or not. However, there is an unfairness argument that I believe they're looking at for class action purposes. I will not be on the case, but it is something we're looking at. And I suspect that if it moves forward, one of the damages and one of the remedies will be updating credit reports properly to remove those 30, 60, 90. That case hasn't been filed yet, but I know they're still researching it.
I just muted you. Sorry.
Okay. Can you hear me now?
Yeah.
Can I?
Yeah, sure. Go ahead and with your question. Then we're going to go to Albert.
Okay. What I've noticed over the past couple of years that as student loans, we're supposed to, whether they got notified or not. And since it seems like servicers only report every 90 days, so it doesn't show up as a 30-day, it shows up as a 90-day, that if the consumer student is prompt about immediately contacting the servicer and just putting it in forbearance or deferment or whatever it was before, most of the time the servicer will just delete that 90-day late. And when I see a subsequent report, that late is gone, it's back into good status. It doesn't happen all the time, but thankfully it happens, I would say, most of the time if the consumer is prompt about immediately contacting that servicer.
So are they backdating the forbearance?
I don't know what they're doing with the servicer. All I know is that I see the updated credit report, that 90-day late is gone, and that student loan is back in good status.
So that is at the mercy of the servicer, and they're probably doing it as a good boy treat, we'll call it. But you actually touched upon something that because the forbearance backdates doesn't mean the report backdates and updates. What you're seeing there, Carl, is, I think, magic, but it's certainly not a policy and certainly not a requirement. So it's happening, but it's not required.
Albert, go ahead with your question.
Yeah, so Mr. Cohen, great presentation. I got lost in the acronym of spaghetti that we toss out there. Is there any cheat sheet or something that you could break down acronyms for us, please?
Actually, yes, I do have one. So I'm going to have to dig it. And I think what I'll do is I will email it to you, Stephanie, so that you can disperse it. It's
okay.
A glossary list that I put together of acronyms. So
Sure.
you have IDR is driven repayment, IBR income-based repayment, ICR income contingent repayment. As you earn, save is dead. We don't care. RAP, repayment assistance program. That's the new one under the one big beautiful bill. So those are the big two other acronyms you need to know, which your clients probably don't. One, DL, loans. Those are loans that were originated by the Department of Education. That program rolled out in '94. Then there's the older program, FFEL. Some people put the P on it. They call it FEL, they call it FEL, they call it FELP, whatever you want. Federal Family Education Loan Program. That's how student loans started way back in '65. And that program terminated July 1st, 2010. So here's your nugget. Any loan before '94 is an FFEL. Any loan after 2010 is a direct. Your gray area is '94 to 2010. And they could have been FEL, they could have been consolidated to direct, they could have been reconsolidated back to FEL, who knows? But any consolidation or origination after 2010 is a direct loan. Why does that matter? Someone brought up COVID forbearance. The COVID forbearance only affected direct loans, loans held by Department of Ed, of March 2020. FFE was not covered by COVID forbearance, actually was covered by COVID forbearance. But FFEL wasn't affected by the CARES Act, COVID stuff, until March of 2021, when Biden got into office. And this is where a lot of people get weirded out. Direct loans never required payment under the CARES Act. As of March 2020, boom, automatic forbearance. They didn't have to do anything. FFEL, however, even as of March 2021, this is weird. Payment was still required. And if you didn't pay, they couldn't necessarily report on your credit. They could before March 2021.
Even
But
though
here's
it
weird.
was federal.
Correct. Because it was FFEL and not covered by the CARES Act. As of March 2021, here's where it got weird. You were required to make a payment, but if you didn't, you couldn't default. If the loan reached 270 and should have defaulted, the FFEL lender, or if they assigned it to the guarantee agency, was supposed to reassign it to the Department of Ed. I know for a fact ECMC did not do this all the time. If you have one of those, let me know, because that I think would be an excellent FCRA case, because ECMC screwed this up and I know they did it.
Well, we see ECMC all the time.
Yes, I bet you do. And I spoke to ECMC about this way back, and they said, "Oh, well, we don't have to transfer it immediately. But we think we don't transfer it until after this CARES Act ends, or blah blah blah." BS is the polite way I'm going to respond to that. I know that the regs were very clear that they were sign it immediately.
To Department of Ed?
Yes.
Weird cheat sheet. Can you please brand it? And I have your contact information on there. And could we reach out to you or your paralegal staff if we have? Okay. And now is that a consultation, or would that be hourly, or?
Even better, I like to do everything via email. So we can talk via email first, and is there something that we want to have a phone conversation about or not?
Okay.
So
Thank you, sir.
there. So
I have a question.
go for it.
Go ahead, Linda.
Myself have direct student loans. Some of direct student loans are 25 years, 15 years, 12 years, and I've been in that you're talking about, and they still have not started me on payments yet.
So
Can those be deleted?
no, they're not deleted. The question is, are you in the save forbearance? If you're in the save forbearance, they're not going to restart you willingly. They're going to wait till they migrate you in February or March. You can voluntarily enroll in income-based repayment, or pay if that's applicable. You can voluntarily do that and start the clock ticking again. And those loans that hit the 25-year, guess what? They just out notices 2 weeks ago that IBR forgiveness is on again. I've got clients that are getting the IBR forgiveness right now, and they'll get it by Thanksgiving. So what I'm telling a lot of people is, if you're close to the finish line, get into IBR now.
Okay. And the IBR is?
Income-based repayment.
Okay. Okay.
Okay, so I have a couple other questions. One, is there and will still be a rehab program for defaulting?
Rehab is alive and well. It is already going on. I'm hearing it's actually working easily, just as it did before COVID. It's right back on the menu. One thing to note, direct loans are no longer going to outside collection agencies. They're all staying in-house with the Default Resolution Group. So you only have to deal with one company. You don't have to look for these outside collection agencies anymore.
So you're only Default Resolution Group now, so you can it's easier to call in. So is the
Correct.
same type of process, do they still, if they make, 9 on-time payments over 10 months, they will remove the collection information that was associated with loan, not the collection information?
Correct. And if they have a wage garnishment going, that wage garnishment stops after the 5th rehab payment.
Oh, that is good to know. Write that down, you guys, everybody. That is something you need to know to tell your clients. That is important, that garnishment stop after 5 months.
I want you to contact your client right after that and say, 1, has the garnishment stopped? 2, you still owe month 6, 7, 8, and 9. Don't stop rehab just because the garnishment stopped, or you're going to screw yourself.
Right.
You got to finish the program. It's like your antibiotics. You got to take the whole bottle, even though you feel better.
Right, because there's 2 ways to do that, to get out of default. You have 2 ways. One gets rid of more like the derogatory information on the report. So for us as credit repair professionals, I love that plan myself, because I want to see their credit cleaned up. or they could do a 3-month consolidation, correct, Josh, where they can tell us about that.
Okay, so to get out of default, you have two choices. We have the rehabilitation, which we spoke about just now briefly, and two, you can consolidate. Now, things are getting hairy here because if you consolidate, whether it's defaulted or not, if you consolidate, you reset your IDR forgiveness clock. If
Oh,
you have someone that just defaulted in 2024, but they had 20 years of IDR credit, forgiveness credit, because of the Biden era recount that happened, if you consolidate them out of default, they lose all 20 years. They go back to zero, which is why
okay.
rehabilitation is going to be
That's
much more popular because
huge.
rehab is the same loan. You do not lose your IDR credit.
Okay. That is
Question.
a huge distinction, you guys, because a lot of times what I see with credit repair professionals, they're talking out on media. They're, oh yeah, do it fast, 3 months, no problem, just consolidate. But you can really hurt your clients in the
Yeah,
long
give me
run if you're doing that, especially if you've been paying for years and they
yeah,
have
this
a
is
lot of forgiveness built up.
and this is all new. Remember, before Biden, we didn't have an account adjustment, and IDR in general was still new. I barely had anybody that had more than 5 or 6 years of credit. So fine, consolidate, who cares? Now, with even 15 years of credit, that's a lot to reset.
Yeah, definitely.
So, um,
Okay, Gina has had her hand up for a little bit. Gina, go ahead and ask your question.
Okay, I previously had federal that is 40 plus years old. It is not showing up on my credit report, but it is up when I go to apply for financial aid. And I'm being told that there is no way to address it. I just need to repay it again, even though it was previously paid.
Yeah, right.
all right. So here's the number one, and this gets me into something else that I know that you need to know. How do you know if a loan is for private? You or your client, only the borrower can do this, has to log into studentaid.gov. Federal loans are there, private loans are not. So when your client says, oh, I have a Sally Mae loan, that doesn't tell you anything. They log into studentaid.gov, they get the student aid report. Only federal loans show up there. If nothing shows up, guess what? They have private loans or perhaps a 40-year-old federal loan. I can tell you, Gina, what I would ask, I put my email address in there.
Yes,
I'm happy with your stuff. Go get your student aid report and forward it because it sounds like it's probably a really old Perkins loan that got lost in the balance. Perkins loans were administered by schools, and schools did a shitty job of doing things with these. There's no other word for it.
that's what it was.
And the problem is, unless you have proof that you paid it, you didn't pay it. You're going to lose that one. However, Perkins loans tend not to be much, and there are ways to work, not great, but some kind of settlement and just be done. Worst case scenario, you could always consolidate it out of default, okay, and carry on, and you can get more aid if you need it. So
Okay.
I'm happy to look at that for you. Send an email.
Thanks, Josh.
Okay, Arndra, go ahead.
My question is, I want the recording because I jumped in late. And my question, up until now, we just remove them off the report. We did all of this conversation. I know about it, but I usually just say, well, you got to still make arrangements, even though we remove it. You got to go make arrangements because you still owe the money.
Yeah, so this is actually a very important distinction for your clients. Clients have this, not necessarily wrong, but sort of mistaken idea that it's not on my credit, I don't have to worry about it. That could be true for any other consumer debt. Okay, and as you probably know, a loan in good standing stays on your credit. It falls off after 7 years, either after you off, or if you default, it's 7.5 years. That timing still applies to federal loans with two exceptions. One, if it's an FFE that defaulted, the guarantee agency will use ECMC as an exception. They can report it for up to 7.5 years. But if ECMC transfers it to the Department of Ed under a default claim, that is legal re-aging. The Department of Ed is allowed to now report it for an additional 7.5 years. So technically, It could be on your credit for 15 years. That's legal. The other exception are Perkins loans. Perkins loans, by law, stay on your credit report until fully paid or defaulted for 7.5 years, whichever is longer. So if you've been in default for 12 years on your credit report, it's still there. The beautiful thing is, with the Perkins loan, if it's been over 7.5 years and you fix the default, it immediately falls off your credit. Okay. So fixing a Perkins default, definitely credit worthy. Let's say with Gina's example, it's been 40 years still on her credit. If we consolidate it tomorrow, as soon as it's consolidated, boom, falls off of her credit immediately. And by immediate, I mean when they get around to updating the report. But yeah, so those are your two exceptions for credit reporting. Otherwise, it is the 7.5 years. The problem is the statute of federal loans doesn't exist. There isn't one. So even though it's on your credit, yes, you're correct. You still owe it. Out of sight, out of mind. Our clients are ostriches. Bad idea. Get your head out of the sand. Let's do something.
So I have a client. So this was a really weird situation. So I have a client, he called up and he said he has 2 collections that just randomly showed up on his credit report. He had no idea what they were. He's like in his 70s. They just were like they literally showed up in like January and charged off by June. And he was like, I have no idea what these are or what he theft. So I absolutely haven't taken out any student loans, blah, 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 blah. So we actually filed identity theft on it because he was 100% sure it was identity theft. So we did the whole affidavit thing, sent it off. One of the bureaus fixed it. So then the other one was still, so I went ahead and sent it over to my consumer law attorney, right, to file a case.
Yep.
So what it ended up being, it was his, okay, from 50 years ago, from 1970.
It's an old Perkins loan, I bet.
Yeah.
Yeah.
And so that's what's on there. So what do you
So let me
do? Like, and he
so-
had a bankruptcy. So this even convolutes it. He'd
Okay,
had
you've got
bankruptcy
great questions.
years ago, and there was a thing where he had a settlement in the bankruptcy. That's how they figured it out. They looked at the bankruptcy, but he never did it. He never paid the settlement through the bankruptcy.
So the settlement through the bankruptcy should still be valid. It doesn't expire. Although interest might have accrued. So what you're seeing here, this is also Gina's issue. The Perkins loan program died under Trump 1. 2018 was the last loan. There are no new ones. And the Perkins program is weird. It's a federal loan, but the loan is originated and administered by the school. So you weren't dealing with Mohila and Nelnet and all that. You were dealing literally with the school. And a lot of people thought, oh, it's just tuition or something, and they forgot about it. Or the school, even worse, didn't administer it correctly. They didn't bill for it. People forgot about it. It fell off. Who knows? Perkins loans are different than Stafford's and Plus and what we're used to. It stays with the school unless the school hands over the entire Perkins portfolio back to the Department of Ed. And that's what happened in 2018, 19, and 20 during COVID, because the schools had no use for their Perkins program anymore. They weren't allowed to administer new ones, so they didn't care if they got back the money or not. So I'm seeing like 99% of schools return their entire Perkins portfolio to Ed during COVID. And now that COVID's done, they woke up and like, wait a minute, we have all these debts. And poof, they started collecting on them. They started reporting on them. They were magically in good standing for like 2 months, and then you defaulted, even though in truth, it was never cured. So I'm seeing they're just finally showing up. And unfortunately, it's a federal government debt. Unless the consumer has absolute proof they paid it off, which they don't because it was a decade ago before digital records, you're going to lose. The good thing is I'm not seeing a lot of accrued interest on these. They're still small, $2,000, $3,000, $4,000, $5,000. You can still work some kind of deal, not necessarily a nice one, but some kind of deal, and just be done. Or worst case, consolidate it. That consolidation is technically eligible for IBR. If you still have other loans, sure, fold it in. It doesn't change your payment. So that's probably what I'm seeing. But if you've got that bankruptcy thing, I think that bankruptcy settlement should still be valid. Like, oh, hey, not only did I forget to collect on it, you forgot to collect on it. So let's just, forget that it's been 30 and let's just do this deal and be done because he's 70 and
It's like 55.
although mostly so the problem is federal remedies. As seniors, they can take 15% of Social Security. That's ridiculous, but they can. So,
Okay.
but you should be able to still use that deal, I would think.
Okay. And then Tiffany has had her hand up. Go ask your question.
Hello. Yeah, so my question really kind of the same thing. I've had a student loan since 1999. It was a 2625. And part of the loan, I don't believe it was but part of it was it didn't have any on it. Well, I guess maybe I never paid on it, but it never went into the, I always keep it, in a standing. That I'm coming out of retirement from, raising kids, over the past, so well, I guess in 2010, Great Lakes, I got a call lady from when it was kind of in trouble. I guess maybe, yeah, I kind of got behind on the payments or I had not paid and wonder I knew something but hadn't. And the Lakes called me and, was talking and I gave her all my information where she went into that federal website that you were talking about. I gave her all information that she needed to get in there. I don't know what I was thinking, just little babies, not thinking at all. And so my loans ended up over at Great Lakes, and the part that didn't incur interest is now interest. And so now from that 26.5, I owe like what 4,500. It's not a whole lot, but still more than what I actually borrowed.
So Great Lakes was a guarantee agency. And if a loan got transferred to Great Lakes, that tells me you might have defaulted. You may not have known it, but you did. The bottom line is your record should be on studentaid.gov. Let's take a look at it because under Biden, you received forgiveness credit whether you were ever in IBR or not for time you were not in default. And if this loan is from 99, you've been out of school since 2000 or so, you might be close to the finish line depending on when this default happened and things like that. So I'm going to extend you the same courtesy. Right. I'll put my email address in there. Get me your student aid file.
Will do.
Okay. Wendell has a question in the chat. How can you delete the loans or the 90/120 day lates that are causing wake up bad credit? They have started paying, but the lates are wrecking mortgage approvals.
All right. So legally speaking, I don't know how you get those off because if they were technically late, it's technically allowed. But this is, again, that issue where there is advocacy groups looking at class action because Elnet and Mohila threw everyone into repayment at one time, but the billing system wasn't working correctly. And so there's an unfairness argument here in mass. Right now, I don't know that there's much that you can do about it, although I'm really surprised the mortgage company is holding it over people's head. Everybody's got a student loan and they're all in issues. I think the important part of here is make sure they're on a payment plan now. Now I'm going to segue into something important. Not every mortgage company accepts an IDR payment plan, an income-driven repayment plan. Some of them say incorrectly, oh, well, it's speculative and you could be kicked out. No, you can't be kicked out unless you're an idiot and you forget to recertify. You're not going to be kicked out. The only way you'd be kicked out is if you start making too much money. Well, that's not a problem for a mortgage company. That means you can afford your loan. So what I tell people is if you're looking at a mortgage, ask the broker or the banker, whoever you're dealing with, before you fill out do you accept an IDR payment or not? Because if they don't accept it, here's what they do. They recompute your payment at 1% of the balance of the loan, regardless of what your payment is. And that will kill people's DTI and suddenly they can't get a mortgage. So ask that question before they apply. Don't ruin your credit on a pull for useless reasons.
Okay.
But back to the question, there's no way to necessarily delete it legally under the FCRA as far as I'm aware.
Okay. Jacqueline has a question. I have a question. Client has all federal loans. Only loans reporting negatively were serviced by S-Loan/Nelnet.
Yep.
Have been consolidated with. Recently received an email stating payments would resume in November, $1,000 a month. Client applied for SAVE program at the same time. They applied for consolidation. How do I advise?
Okay, so Sloan is a nugget for me. Sloan only services loans. It's a Nelnet division for FFEL. This person consolidated, hopefully before June 2024, and got the IDR recount. They're saying their payments are $1,000 a month because SAVE is dead. And if they're kicked out, if they're not in the SAVE forbearance, they're in the standard, which is $1,000 a month. The very short answer, IBR. SAVE is dead. Oh, but I applied for it. That's great. You applied for something that's dead.
Yeah.
IBR is usually the safe bet here. So I would do that. You can get a 60-day forbearance while they process the IBR application. That's what I do on that.
Okay, Carl, go ahead.
Carl, you're muted. There we go.
Yeah. Okay, there we go. I've had 2 clients now that have had student loans show up on their credit report as late. And these were didn't actively monitor credit report. So when they first didn't think, they didn't know. They only found out when they went to get a mortgage or, the negative reporting happened. And 100% were not theirs. We did the route, filing FTC identity theft reports, send it to servicer, send it to the credit bureaus. And the servicer was just horrible to work with. They federal forms filled out, which those forms don't make any sense. Ask for information that there's no way the client, who loans. And then after we sent that in, then they're like, well, we want you to contact the school. We want some information. That was the point where I sent it off to my consumer protection, who told me that, and I recently read an article, that identity theft for student loans is like the latest thing for identity theft scams because it's so easy to do, because you can get on student loans $2,000, $5,000, whatever. Oh. And the victim's not going to know for months or maybe years.
Yes, but no. See, here's the problem I have with that theory. If you take someone's credit card, you have the card, you can go spend it at Target right away. If you take out a federal loan, the loan money goes to the school, and the perpetrator doesn't get that money unless they're enrolled under that fake name and there's no bill due so that it's refunded back to that person. The place where I see identity theft a lot with Parent Plus loans, with federal loans, is Parent Plus loans, where Johnny the student and dad have a deal where dad says, okay, I'll get a loan for you the first, that's it. And the second or third year comes along, and now Johnny doesn't have enough money for it. Financial aid says, well, just have your dad fill out the Plus loan application again. I'll email it to you. You forward it to dad. Well, they talk to dad. Dad says, no, that's our agreement. Johnny goes in and says, you know what? I'll take it out. I'm going to be a big shot business guy. I can pay it off, no problem. So Johnny fills it out with what he knows from dad's information. It's pre-populated anyway from the first loan. And maybe Johnny changes the address so the bill goes to him. And dad doesn't know until Johnny can't pay the Plus loan a decade later. That is an ID theft where Johnny didn't need the money, the cash. He needed the bill to be paid, and so it worked. And those, yes, I will tell you now, you must use the Department of Ed form for that. And you're right, you may not know all that information, but that's the point. And so if you don't know the school, you don't know this, I don't know. I don't know. I'm the victim here. I don't know. Mm-hmm. You have to do that. You cannot file an FCRA case without that. To do, legally speaking, their defense is failure to exhaust administrative remedies. You didn't try to do a discharge. Now, I know that's going to fail, but you have to do it anyway. And that's how I set these up. I do it. They fail. We do the formal FCRA dispute. They fail again. Now I go in front of the judge and say, what else do you want us to do? We've already jumped through 30 hoops. And the judge says, yeah, that is kind of odd. What do you want us to do? So as annoying as it is, yeah, you need to do it.
All right.
I saw a question in the chat that I want to real quick.
Okay, go ahead.
It was from Cass. If you can consolidate old loans to erase the history of payment loans. Yes, you could, but remember, if you consolidate, you are resetting your client's IDR forgiveness clock. So be careful. If they only have 2 or 3 years of IDR, sure, you want to consolidate them to reset those late payments. That's fine. But it doesn't clean them off. They just age off eventually. Just because you consolidate, and you get a new trade, doesn't mean the old trade line falls off necessarily.
Oh, okay. So that's
at
me.
the whim of,
Yeah, I'm Tony. Thanks for answering that. Yeah, I wasn't sure if when they do that, I thought maybe those old loans just disappear and just show as a new loan, or if there's.
you do a new line, but again, the old ones may not fall off. However, in the old days with rehabilitation, there were some that would delete their trade line after successful rehabilitation. And that was for FFE with, and this is important. Sorry, I'm going to get into the weeds here. When you rehabilitate an FFEL loan, the loan is technically sold to a new bank. So the old bank trade lines can fall off and you get a new trade line. It's not a new loan, it's a trade line. But that doesn't happen with direct loans. Direct loans, it's the same loan. Now, speaking of credit, because you guys are going to love this one. Oh. Imagine that you've had some default for 40 years and it's a direct loan, not a Perkins. It's a direct loan. They've been in default for 10 years. Let's just say 10 years. Old enough that it fell off their credit report. If you do a rehabilitation, that old trade line comes back. None of the negative history comes back, but it says the original open date back in 2000 or whenever it was. So now it looks like you have a loan that's put in good history for 24 years. What does that do for their credit score?
Yeah, it's a nice
That's
trip.
beautiful.
Yeah, because if it's within the last 7 years, they're going to still report the late payments that led up to the default. But if it's over 7 years, it's nice, new, beautiful trade line.
And even if their credit, if they defaulted 7 years ago, it's still going to age off. That 7.5 year clock still. So it's off anyway. And a lot of lenders, they know about default. They don't care that it was so long ago. What they care about is, did you fix it? Okay.
Yeah, they really care about the credit score. I mean, I was a lender for 25 years. It's really based on the credit score. So, but I can say that I have had very good rid of these late payments once they have turned around and put them into. I can almost always get rid of the lates just by sending a letter in to the bureau, and they've been like deleting them left and right. Any more? Denise, go ahead.
Okay, great. This is a great class. I'm kind of like have a parent plus loans. That's all I have plus loans. I have.
Sorry, you're kind of cutting out, Denise. Try it again.
Can you hear me now?
It's still kind of wavy.
Is that better?
There we go.
I'm sorry. Is that better?
Yeah.
Yes.
Okay, great. I have had parent plus loans. I have parent plus loans. And I have, back when they started back putting them on the credit report, a 90-day late, a 30-day late. Just getting to this space of credit repair and things like that. I need to look at my best options for my student loans because I put them back in forbearance with, I think I'm in with NailNet. So I need that grace that you just gave the other person to call you and go over my loans to see where I am.
Yeah, all via email. So you can email me your student aid report. We'll take a look. I don't like forbearance. Forbearance is kicking the can down the road. Another problem with forbearance. Legacy loans, those before July 1st, 2026, you only get 36 months of forbearance for the life of the loan. You're going to run out. With the new loans, the big budget, beautiful bill loans, they're even worse. They're allowed 9 months of forbearance every 24 months. It means you can't even roll 36 months of forbearance if you need. Maybe you're a stay-at-home mom and you've got a kid and you're going to wait until they're in preschool. That 36 months could be useful, but now you don't get that. You get 9 months to be pregnant, and then boom, you pop out the kid and start paying your loan. I mean, you can tell who put this together. I don't need to say anymore. This is going to be an issue. Nathan, I do not. In fact, the class act that Stephanie talked about was way out when I was a baby lawyer in 2009. I sued a company called General Revenue, formerly a subsidiary of Sallie Mae, because they were doing rehabilitation wrong. That has since been fixed. I don't claim credit for that. That was back in 2009. I actually don't do a lot of class actions. If I get a juicy one that looks good, maybe, but I work with a lot of talented class action attorneys that I'm happy to pass on to with. My focus is student loans. So 99% of what I do is translate, kind of what I'm doing here, translate what the hell is going on and how do I get my loan back on track. Maybe it's IBR, maybe it's PSLF, which we touched on, whatever it is, in plain English. And by the end of the conversation, Why couldn't Nelnet tell me this? Because Nelnet's script is different than mine. I don't have a script. Nelnet has a script. You didn't ask the right questions. Remember, Nelnet isn't there to help you. They're there to help the Department of Education. So, I love when people say, oh, well, I can get my payment history from Nelnet. Why would you ever rely on the other side for your payment history? Have a dispute. I will say this. I've never really found an accounting error in my 18 years that is worth anything, because the accounting is done through software, and the software doesn't really screw up. It's math. It's just not understandable. I can usually get through and explain why things are the way they are. It's not pretty, but we can do it. So I do whatever I can do to help someone. Do student loans have arbitration clauses? Federal loans never have an arbitration clause. Most private lenders got rid of arbitration clauses because the CFPB told them to. I don't know if they'll come back. It's never been an issue. I do defend people in state court, and that's only to settle the debt. And if that doesn't work, believe it or not, you're going to love this. I will take people into bankruptcy and file a discharge action. Now, federal loans, I've been able to get them discharged because of this new process going on. Private loans, I'll bring them all day long into bankruptcy, and I use it to renegotiate the terms. Sallie Mae Navient National Collegiate Student Loan Trust, I get them to 0%, and we work out a deal, and they pay. And it might be discounted, it might not, depends on their income, depends on their age. I know bankruptcy isn't something we love as credit, but when you've got someone with unmanageable debt, bankruptcy can be an awesome tool.
For sure. Yeah. And we need to use all the tools, as a credit repair professional. If somebody just has overwhelming debt, it's absolutely a good tool. And it should be used. Of charging them for 6 months of credit is not going to help them in any way, shape, or form.
Yeah.
You got to put them into the right program for them.
Great questions. I love these questions. This is good stuff.
Yeah. Okay, I think, does anybody else have any? We have 2 minutes. We always end on time. I do like to respect our speaker's time and hit on.
I have a question.
Okay.
He was saying something about the trade lines. I was trying to listen, but I was doing different things. Then he go back in very last, I think it was like 5 minutes. How the trade line come back on the account, and it could be from like 2000. But I'm gonna mute myself now. I just want to listen to that part.
Okay, so what I was specifically is an advantage of rehabilitating a defaulted loan. Because when you rehabilitate, remember, it's the same loan. Consolidation is a new loan. It's the same loan. It means if the loan has been in default so long that it fell off the credit and you rehabilitate it, that credit comes back because the loan is active, and none of bad negative history returns with it. So you're now showing a trade line in good standing all the way back to its date of origination. 1995, 25, whenever it was. And so you're giving someone this beautiful long-term good standing debt. That's invaluable. That's a beautiful thing. So rehabilitation is really a much more useful tool than it had been a decade ago.
Attorney, great presentation. Now you mentioned about you would take a case all the way up to bankruptcy court and get better terms.
Mm-hmm.
Now, if the better terms, that's not us. So is your client paying per hour for your service, or how does that work?
Those are two separate questions. Yes, what I do is settlement. It may not be a lump sum settlement. It might be a long-term settlement that stretches out for 20 years, but there's no interest, which means there's no rates to pay it off, number one. It also protects co-signers, number two. And number three, everything I do, with the exception of FCRA lawsuits, are flat fee. Because why should my client have to worry about me doing extra work because the other side wants me to do extra work? I never do that. I want my client to know exactly what my fee is going to be. I can finance them. I can make this work. I'm all about that. Real quick, let me just explain how I work for those interested, whether it's for you or your clients. I offer a free review for everybody. I don't talk to anybody until they do my online form. So if you go to my website, studentloanlawyer.com, right on the front page, you'll see free review. You hit that or your client hits that, they register, they do an online intake. If they have federal loans, they'll be required to upload their studentaid.gov information. I review it and I give them a free review they get via email that explains, here's what I see, here's what I think for your options. Yes, I can help you, or no, I can't help you. Don't book a time with me. There's nothing I can do here. And usually that's, okay, you need someone local or something else. But for everyone that I can help, I tell them briefly what I think their options are. I give them a link if they want to book a call. I charge $250 for a 30-minute call. I record that call with permission. I send them that call. If they want to hire me for more, they can. If they want to DIY it at that stage, that's fine too. I allow anybody who wants to email me, and I'm happy to continue supporting them. So I try to make this as easy as possible. But again, I don't want anyone paying me until they know I can do something for them.
Thank you. Great presentation, sir.
So, and you guys are welcome to email me with other questions if you think of them. That's fine.
Okay, guys. Well, we're gonna wrap it up. So, replay. We mail out replays. If you're on our email list and you got this in your email, you will get. If you are not on our email list, you came from like a different group, like Smart Credit or Credit Con, you just clicked on the link to come into the presentation tonight, then just email me at stephanie@credit.ai. Email me and I'll add you to our email list so that you, I don't think he said, you didn't say anything about paying out for referrals.
I haven't, but I'm not above if we get a juicy case, I'm happy to share money.
There we go. Happy to share money. We love it.
I haven't gotten one of those juicy cases because remember, what I see and what you see are sometimes a little different, but I'm always practical about it and I'll tell you from the get-go what I see.
Yeah, so you guys look for juicy cases. That's the trick. Find a juicy case. Yep. All right. Well, I do appreciate everybody that came. Josh, did you have some closing?
No, but Stephanie, if you will just hound me to make sure I get you that glossary list with contact info, I'm more than happy to do that for you. Yeah, when you start talking acronyms to your clients and their head starts spinning, it's good to be able to come back down.
Yeah, and I'm gonna go ahead and attach my Fathom recording. It takes really, really good notes. I'm gonna do the summary for this because it's gonna break down all of those acronyms in that summary for you guys. I'll go ahead and we'll add that in the replay that goes out, which will be really helpful too. And we'll get that sheet from Josh. And anyways, thank you guys so much. Thank you, Josh, so much for coming on. We appreciate your knowledge and sharing it with us. And I will see you guys all next week. And have a great night, everyone.
Thank you. Bye.
Bye-bye.